Profit margins are an essential measure of a business's financial health and efficiency, revealing how much profit a company makes relative to its revenue. They show what proportion of sales revenue remains after costs are deducted and are usually expressed as a percentage. There are different types of profit margins, with gross profit margin and net profit margin being the most commonly used. Each provides a different perspective on a business's profitability, with gross profit margin focusing solely on direct costs and net profit margin considering all costs. The gross profit margin is a measure that shows the proportion of revenue remaining after deducting the cost of goods sold. It ignores indirect costs, such as rent, utilities, and administrative expenses, focusing only on the direct costs involved in producing or purchasing the goods or services a business sells. For example, a small bakery's gross profit margin would be calculated by subtracting the cost of ingredients like flour, sugar, and butter from the total revenue generated by selling cakes. If the bakery generates £10,000 in sales and the cost of goods sold amounts to £4,000, the gross profit would be £6,000. The gross profit margin is then calculated by dividing the gross profit by total sales and multiplying by 100, resulting in a gross profit margin of 60%. This means that for every pound the bakery earns in sales, 60 pence remains after covering the direct costs of the products. The gross profit margin is useful for assessing how efficiently a business is producing or sourcing its products. A high gross profit margin indicates that the business is able to sell its products at a significant markup over the cost of production, which suggests strong control over direct costs or the ability to charge premium prices. However, because the gross profit margin ignores indirect costs, it does not provide a complete picture of overall profitability. A business may have a high gross profit margin but still struggle to cover its operating expenses, leading to lower net profits. This is where the net profit margin comes in. Unlike the gross profit margin, the net profit margin takes all costs into account, including both direct costs and indirect operating expenses. This provides a more comprehensive view of a business's profitability, as it reflects the bottom line, the actual profit that remains after every cost has been paid. Using the bakery example, after deducting not only the cost of ingredients but also other expenses like rent, employee wages, utilities, and marketing costs, the net profit margin shows the real financial outcome. If the bakery's total operating expenses add up to £5,000, in addition to the £4,000 cost of goods sold, the net profit would be £1,000, based on the original £10,000 in sales. The net profit margin is calculated by dividing the net profit by total revenue and multiplying by 100, giving the bakery a net profit margin of 10%. A 10% net profit margin means that for every pound of sales, only 10 pence is retained as profit after covering all costs. This figure can be quite revealing, as it highlights whether a business is managing both its direct and indirect costs effectively. If the net profit margin is significantly lower than the gross profit margin, it suggests that the business's indirect costs, such as overheads, are high and may need to be reviewed. For instance, if the bakery has high rent or is spending too much on marketing, it might need to find ways to reduce these costs to improve its net profitability. Both gross and net profit margins are critical for different reasons. The gross profit margin allows businesses to focus on the efficiency of their production or purchasing processes, while the net profit margin offers a broader perspective on the company's overall profitability. For example, a manufacturer with a high gross profit margin might feel confident about its ability to produce goods at a low cost. However, if its net profit margin is low due to high administrative or distribution costs, it may not be as profitable as it initially appears. A close examination of both margins can help the business identify areas for improvement, whether by reducing production costs or finding ways to cut operating expenses. Comparing profit margins across different years or against industry benchmarks can also offer valuable insights. A business that consistently sees its gross profit margin shrinking may be experiencing rising production costs or increased competition, forcing it to lower prices. Meanwhile, a declining net profit margin might indicate that overhead costs are spiraling, perhaps due to expanding too quickly or not managing resources efficiently. By tracking these changes, businesses can take proactive steps to address the underlying issues affecting profitability. In conclusion, Gross profit margin and net profit margin are two key metrics that offer distinct but complementary insights into a business's financial performance. Gross profit margin focuses on the efficiency of managing direct costs, while net profit margin takes all expenses into account, providing a fuller picture of profitability. Together, they help businesses make informed decisions about pricing, cost control, and overall financial strategy.